Ever wonder why some people seem to get richer every single year while doing what looks like nothing? No new job, no lottery ticket, no viral business idea. They're not smarter than you, and they're not luckier than you either. They just know about a handful of assets that most people never even hear about, let alone get the chance to buy. Today, we're counting down 7 things wealthy people quietly buy that almost nobody else knows exist. Some of these you can actually start exploring with very little money. Others take more time and patience to access. But by the time we hit number 7, you're going to look at money completely differently. Let's get into it. Quick reframe before we start. This isn't really about rich versus poor. It's about exposed versus unexposed. Rich people usually aren't smarter with money. They just grew up around people who talked about these assets at the dinner table, or worked with private bankers and family offices who mentioned them as casually as you'd mention a savings account. Most of us grew up hearing about a checking account, maybe a 401k, and that was basically the entire menu we were ever shown. Nobody sat us down and explained the other side of it, the part that isn't advertised on a bank app or taught in a high school class. So today, we're closing that gap, one asset at a time. Stick around to the end, because the last one on this list is the one that quietly ties every other asset together, and it changes how you'll think about everything else we cover. Number 1, municipal bonds, or what people in the know just call munis. Think of a city like a homeowner who needs a new roof. Maybe it's a new school, a repaved highway, or an upgraded water system. The city doesn't have $500 million just sitting in a drawer, so it borrows the money by selling bonds, which are basically IOUs that pay interest over time. Technically, anyone can buy these, but wealthy investors buy them constantly for one specific reason. The interest is usually exempt from federal tax, and sometimes state tax too if you live in the state where the bond was issued. Here's why that actually matters. If a regular corporate bond pays you 5% interest, but you have to pay tax on that income, you might only keep around 3.5% after the IRS takes its cut. A municipal bond paying just 4% completely tax-free could put more real cash in your pocket than the bond that looked bigger on paper. For someone in a high tax bracket, that small difference compounds into real money over the years, which is exactly why this asset barely ever gets mentioned to anyone outside of private wealth management offices. That's the entire reason private banks recommend munis to their wealthiest clients almost before mentioning anything else. Number 2, real estate syndications. Most people think real estate just means owning a home, or maybe one rental property if they're feeling ambitious. Wealthy investors do something different, called a syndication. Think of it like a group chat that decided to buy an apartment building together, except with paperwork and a lawyer involved. Picture a $10 million apartment complex in Austin, Texas. No single investor wants to write a $10 million check, so instead, around 50 different investors each contribute roughly $200,000 through a deal organizer called a sponsor, who finds the property, negotiates the purchase, and manages it on everyone's behalf for a fee. Let's say one of those investors, we'll call her Diane, puts in $50,000 for a small slice of the deal. She doesn't manage a single tenant, fix a single toilet, or even visit the property in person. She just collects a share of the monthly rent and a share of the profit when the building eventually sells, often years later once it's been renovated and its rents pushed higher. This is exactly how wealthy families quietly end up owning pieces of office buildings, apartment complexes, and shopping centers that most people walk past every single day without ever knowing who actually owns them, or that ordinary investors like Diane are sitting quietly behind the scenes. Number 3, royalties. When an artist licenses a song or an inventor holds a patent, they get paid every single time that song streams or that product sells. What most people don't realize is that wealthy investors literally buy these royalty streams directly from the original creators. Imagine a songwriter who wrote a massive hit 20 years ago. That song still earns money every time it plays on the radio, shows up in a commercial, or gets streamed online today. A royalty investment company might offer that songwriter a lump sum, say $2 million, in exchange for the rights to collect every future royalty payment from that catalog.
The songwriter walks away with cash today instead of waiting decades for smaller checks. The investor might then collect $300,000 a year from that same catalog for decades to come, completely detached from whatever the stock market is doing that year. There are even publicly traded royalty companies built entirely around buying up these catalogs at scale, owning thousands of songs and patents at once. It's one of the quietest, most overlooked asset classes out there, and that's exactly why almost nobody outside of finance circles has ever heard of it.
If you're still with me at asset number 3, that tells me you're exactly the kind of person who's about to get ahead of most people watching finance content right now. Hit that like button, hit subscribe, and let's keep going, because the next 4 assets are even bigger than what we just covered. Number 4, cash value life insurance. Not the cheap term policy most people are told to buy and forget about. We're talking about whole life insurance, which builds something called cash value inside the policy over time, on top of the death benefit. That cash value grows slowly and predictably, but here's the part most people never get told. You can actually borrow against it, often completely tax-free, without ever touching your investments in the stock market or disrupting their growth. Wealthy families use this almost like a private bank they built for themselves, sitting quietly off to the side of everything else they own. They take a loan against the cash value to buy real estate, fund a business, or cover a major expense, while the original policy keeps compounding in the background, as if nothing was ever borrowed against it at all. This strategy even has a nickname in wealth circles: infinite banking. It's a lower return asset compared to stocks, sure, but it almost never loses value, and it comes with a death benefit attached on top of everything else. Even banks themselves hold billions of dollars in this exact same asset, which on their own books is literally called bank-owned life insurance.
Number 5, farmland. Bill Gates is currently the largest private farmland owner in the entire United States, with hundreds of thousands of acres across multiple states. Why would one of the richest people on Earth want dirt? Because farmland quietly does 3 things at once that most other assets can't pull off simultaneously. It appreciates steadily with very low volatility compared to stocks. It produces annual income when you lease it out to working farmers. And it acts as a natural hedge against inflation, because when food prices rise, land values tend to climb right along with them. Imagine owning 100 acres of corn farmland in Iowa worth $800,000. You lease it to a local farmer for $250 an acre per year, which works out to $25,000 of passive income annually, while the land itself appreciates another 5 to 6% a year on top of that income, with almost none of the daily price swings you'd see checking a stock app. Most people never even consider buying farmland, partly because it used to require serious capital or insider agricultural connections, though newer farmland investment funds have started opening this asset up to much smaller investors in recent years.
Number 6, private equity, or what's often called pre-IPO investing. This means buying a small ownership stake in a company before it ever goes public on a stock exchange. Early employees and venture investors in companies like Uber, Airbnb, and SpaceX turned relatively small checks into massive fortunes years before the general public could buy a single share anywhere. For decades, this entire world was locked almost completely behind something called accredited investor status, meaning you needed a net worth over $1 million, not counting your home, or an income over $200,000 a year just to legally be allowed in the door. The logic was that private deals are riskier and harder to research, so regulators kept them gated off from everyday investors for their own protection. That's slowly changing now. Newer platforms have started letting everyday investors buy small stakes in select pre-IPO companies too, sometimes for just a few $100s. Though the access and deal quality offered to everyday investors is still far smaller than what wealthy clients get handed directly by their private bankers and venture capital connections.
And number 7, the one that quietly ties every single asset on this list together: trusts. Specifically things like dynasty trusts or generation skipping trusts. A trust isn't really an asset you go out and buy. It's more like the container wealthy families wrap around every other asset we just covered. The municipal bonds, the real estate, the royalties, the business stakes, the farmland,
All of it can sit inside a trust structure that's specifically designed to legally reduce or avoid certain taxes when that wealth eventually passes down to children and grandchildren, sometimes for 100 years or more under current law. The assets inside the trust keep earning income and appreciating in value the entire time, completely untouched by the usual inheritance taxes and probate delays that hit regular families. This is the real reason wealth tends to survive generation after generation inside ultra-wealthy families, while a lot of regular families end up starting over from close to zero every single generation. Inheritance gets taxed, assets get divided up between siblings, and the compounding basically resets back to the beginning. Trusts are the legal tool that keeps that compounding running uninterrupted instead of constantly restarting from zero.
So let's run back through all 7 of these one more time. Municipal bonds for tax-free interest income, real estate syndications for owning a slice of big property without managing any of it yourself, royalties for collecting income from songs and patents that already exist, cash value life insurance for a private banking-style loan source that keeps growing on its own in the background, farmland for steady appreciation plus rental income plus an inflation hedge all rolled into one asset, private equity and pre-IPO stakes for getting in before a company ever hits the public market, and trusts, the structure that holds all of it together across generations. Now, before you feel overwhelmed by any of this, here's the honest reality check. Not all 7 of these require millions of dollars to start. Not all of them require accredited investor status anymore either. Several now have far lower entry points than they did even 5 years ago, thanks to newer investment platforms built specifically to open these doors wider to regular people. Some genuinely do still require more capital or more patience before you can fully get in, and that's completely fine too. The point of this video was never to make you feel behind or discouraged. It was to close the information gap that's been sitting there quietly the whole time, untouched, while most people were only ever shown the front page of the menu. The real difference between wealthy people and everyone else usually isn't intelligence, and it isn't luck either. It's exposure to options that most people are simply never shown in the first place. If today's video gave you even one single asset you'd never heard of before, that alone makes this worth your time. None of these 7 require you to abandon the basics either. They simply sit a few steps further down the road, waiting for you once the fundamentals are already in place. Drop a comment letting me know which number surprised you the most, and let me know if you want a full deep dive video on any one of these 7 specifically. And if you want to learn more about how to be financial freedom, check out my video on that, linked right there on your screen. Thanks for watching, and I'll see you in the next one.